Hey guys, how's it going? Katie Day with Coldwell Banker, here with Jeff Wagner with OneTrust Home Loans, here to talk about timing of loans and credit scores and things like that. So tell us a little bit about OneTrust and kind of the process and what may differentiate you from other loan officers or people.
Sure, great question, Katie. There's a lot of mortgage people out in the city of Houston. Back in the mortgage crisis, about 70% of the people who were in it 6-7 years ago are gone because they can't make a lot of money off just a few clients. So in our business, we need a lot of clients to operate a successful business. So we love the basic loans, regular FHA, conventional jumbo loans. That's right in the wheelhouse. But we're not afraid to take a look at some challenging loans. So self-employed folks, there's a lot of that in Houston. And then there's foreign national loans, there's construction loans, physician loans. So it would be disingenuous if I said we can do everything for everyone, because we can't.
Yeah.
But we can do most products, and so I highly recommend whoever the borrower works with, they should be someone local, where they know where their office is, rather than the internet or out of state. So we recommend that, and you're going to want your lender also to go to the closing with you, which we do. We're not the only ones who do that, but we're one of the few.
Yeah.
Does that make sense?
Yeah, definitely. So we always tell our clients, prior to going out to look for homes, they should get pre-approved. So when would you say is a good time for people to get pre-approved, or how long is that good for, or what's kind of the timing on that?
Here's the answer to that. When we talk to a borrower, they'll ask us, when should we get pre-approved? And we say the same thing, that whether you're looking to get approved for a loan now, currently, or 60 days, or even a year, you should look to get pre-approved now, because you want to know how things look. Okay. You want to know, do you qualify for the loan? How does your credit score look? How do your liabilities look? What's my purchasing power? Okay. And there's no cost or commitment to getting a pre-approval. So that's what we highly recommend. So then you can have a strategy from where to go when you really are ready to purchase a home. And as far as how long a pre-approval is good for, we usually put on a pre-approval letter 60 days. Okay. But for example, if you're looking at a home today and it's 60 days and you're coming up on the 50th, 60th day, and half the time people haven't already found a home. Mm-hmm. So what we do is we talk to them. We don't need to read-pull the credit at that point. We'll just ask them. So if you were the borrower, I'd say, Katie, it's the 50th day now. Since we talked last, have you bought a car, a boat? Have you lost your job? Are you making more money, less money? Yeah. And a lot of time there's not been any change, so we can extend that. Yeah. And so that's how it works, but I highly recommend to get pre-approved soon in the process.
Okay.
So that's how.
So how would you say that credit scores impact someone's ability to get a loan?
Wow. Yeah, that's we get that question 80% of the time. And here's how it works. A lot of times people will say to me, Jeff, what is the lowest score you can do to get on, or what's the lowest? And it would be very irresponsible for me just to give a direct answer on that, because it depends on that individual's specific circumstances. For example, we have programs where we can go all the way down to 560. Okay. We can do that, but that person may need to put more down as a down payment. And for example, there are someone who has a 590 credit score. There's good 590s and there's bad 590s. A good 590 is, hey, they missed a couple of medical payments. Mm-hmm. A bad 590 is they've missed 10 mortgage payments in a row. Yeah. That's, I say bad, meaning it takes more time to correct that. Okay. And then also, it's usually in 20-point increments that can affect a interest rate. Okay. As an example, once you hit the 740 threshold, there's 3 credit bureaus, and we take the middle credit score. Okay. The middle is that person's score in our industry. And once you hit 740 and above, that's considered excellent. So if you had 800 or 820, that's still excellent. If you had 740, it's still the same. Yeah. But if you hit 739, that's still a very good credit score. But there's a possibility your interest rate could be affected a little bit. Okay. Could be. So it's the details of that person's specific scores and why they're at that score level. So anywhere from 560 all the way up.
Well, when you're working with a new client, how do you determine, or how do you figure out how much they're qualified for, or how do you walk them through that process?
Yeah. So when we're talking to a client, there's a percentage of clients who will say, I want to spend X amount. Mm-hmm. This is the range I want to spend. Then we have a certain percentage of clients that, Jeff, I don't know what we can afford. I need your help to let me know what we can qualify for. And what we say is kind of the same thing with everybody. It's a simple math equation. On the left side ledger, if you had a piece of paper and you're sitting at home, you're going to put your monthly gross income for the household. So before taxes, what is that gross? For example, $10,000. You make $5 and your spouse makes $5, that's $10,000 before taxes. Then what I'm going to do, Katie, if you're the client, I'm going to take a look at your credit and liabilities. And to do that, it's just a few questions. And then when we look at your credit, it's going to populate for us your monthly liabilities called revolving debt. We're not going to look at what your electricity bill is or your cell phone bill. Revolving debt is, here's some card payments, student loans, monthly credit card debt, and then we put in the price of, we stress test it. So if, for example, you're looking for a $300,000 home with 10% down, what is that mortgage going to cost per month? And we estimate taxes and insurance. If you don't have a specific address, we're going to estimate. And we're going to estimate on the high end.
Yeah.
I think it's always better to estimate on the high end.
Yeah.
So we're going to say, what is that payment on this $300,000 home with 10% down, with taxes, insurance, principal, and interest, and then your other monthly liabilities, the car payments, the student loans, etc. And we add all those liabilities up, including the home. We divide that number by the monthly gross income of $10,000. So say the house payment was $2,000, and you had a $500 car payment and a $500 student loan.
Yeah.
That's $3,000. $1,000 with the liabilities, $2,000 with the home. You divide the $3,000 by the $10,000. Your gross income, that's 30%. That's called DTI, debt to income. And there's ratios you want to stay within certain ratios. So in that scenario, that's a good ratio. 30% all in is good. We like to see it less than 38 total. And again, it's customized to each person. And technically, that particular client could go higher. And we'll tell them, and this is not an exact number because I need more details, say you can afford a $400,000. You could be approved. I don't think I would recommend that as a responsible decision. Because things come up. You want to go to dinner, vacations, you may have children in the future. So that's how we do it, and we love to walk people through it.
If you have any mortgage-related questions or are looking to get a pre-approval, reach out to Jeff Wagner with One Trust Home Loans.